Good afternoon and welcome to today's presentation. Today's topic will be high quality income portfolio. Are we in a sweet spot or is it a mirage? I have the great pleasure today to introduce Philippe Gräub, which is the head of the global and absolute return fixed income team based in Geneva. Philippe will share his views and how to construct in a very difficult fixed income environment a very stable and sustainable quality income portfolio. Over to you, Philippe.
Over to me. You hear me? You hear me well? So it's a presentation, but you can ask questions at the same time. Can you lower the volume a bit as well? Okay, thank you very much. There's one slide to look at. It's slide number 1, and then when you get everything about fixed income investing. It's something that we've been thinking about for many years now, at least 3 years. It's the way governments and central bank look at the market. And we think there is a consensus in the world to target a nominal growth at around a level which makes debt sustainable. We've had a huge shift of the debt from the private sector to the public sector. Basically, corporates, banks are not levered anymore as they were in the past, at the cost of debt moving to governments. And the only way to pay for this debt is a nominal growth, which is structurally at reasonable level. In the US, this chart is for the US. It's about basically 2% real growth and 2% inflation. 2 plus 2 equals 4, and that pays for the deficit. The risk for all of us is not inflation. The risk is deflation. The risk is recession and deflation, as we had it during Lehman, but more during the 9/11, but more obviously during Lehman and COVID. And that's something nobody can afford. 9/11, Lehman and the COVID were too costly for governments in a way, and they cannot afford to have that happening again. So there is a target on growth and inflation. What does it mean very concretely? It means that deficits are structural. We know it's structural in Europe, but it became structural in the US. That's a given, we all know. But it's structural for the next decade, at least. That's one thing. And the second thing is that central banks will continue to be extremely dovish because you need basically to have low rates for basically sustaining this inflation and this growth. So combine agenda of growth and inflation through sustained deficits and through structurally dovish central banks. And that's basically the key for investing in fixed income market. There are two conclusions in terms of investment is that, or basically the conclusion would be the risk is on the government side, the risk is not on the corporate side because of this shift basically in leverage. So what can we expect going forward is probably an environment where default rates are structurally low for the foreseeable future. So I'm not talking about 1 or 2 years, I'm talking about a decade. And the view I'm presenting today is a view that we've had for at least 3 or 4 years. So structurally low default rates and a structural steepening risk in the sense that if it's governments that have the debt, then the long end of the curve is the pressure point, as we've seen in the UK at times, we've seen it in Japan, and that's the big risk for Europe and in the US as well, to see this long end. And just as an aside, it's not for fixed income, but it's the ultimate hedge, which is gold, which is a major call from the bank. Everybody talks about it, but it's also a structural shift in the portfolio construction. There are 2 risks in the market. It's not Trump, it's not political, it's AI and China. Those are really the 2 main risks for the economy. The first one is a technological shift. We all know it, it's AI. The second risk to the market and to any economy outside China is Chinese competition, which is intensifying. They haven't succeeded, China, to make the transition from external exports to consumption. They will probably never make it because there is a lack of trust in the government from citizens, which means that they'll become more and more aggressive in their export policy. That's true for cars, that's true for any type of new technology. That's even true for AI in reality. For fixed income, it's very complex subjects, but for fixed income, what matters is that those two risks have kind of the same elements, which are, one, they are a risk to labor. AI is a risk to labor in the services market. China is a risk to labor in the manufacturing sector. So both combined, both services and manufacturing at risk, and it's deflationary. So when you have a shock or a risk which is deflationary, and that is a risk to your labor market, what do? You do deficits and you cut rates. So those risks are reinforcing basically this view. The conclusion in terms of fixed income is that corporates is the new treasury. And lower level or lower rated fixed income is better than good fixed income in the past. Those are the two conclusions. There's a structural shift that will happen where basically in the past, everybody, private clients, institutions had or still have treasuries and high quality investment grade. And we're going to see an entire shift into what we call income strategy. And this is a strategy that we launched 3-4 years ago with this framework in mind, which is again a 10 years or decade risk framework in mind. The idea is really the following, is that because of these low rates, low default rates, and dovish central bank, it's worth taking additional risk on the credit market. And the market which is the most interesting is the BBB, BB segment. Broadly speaking, I'm not talking only about corporates, I'm talking about CLOs, I'm talking about emerging market. All those risks which bear very little default rate, but attractive income should become the core of the holdings of any fixed income investor. This is our call, and this is our investment view. So what is interesting very concretely is that from moving to those safe fixed income into this income area, you just pick up a marginal default rate. So you see that treasuries in theory have 0 default rate, investment grade single A's have 0.1, and BBBs, BBs have 0.3. It's when you go really into high yield, not even triple C's, that you have the defaults. What is very interesting is that for a marginal default rate, of course there is more volatility, but we want to get this volatility given our macroeconomic framework. You get a significant pickup, and you can get, and that's the yield of the income strategy that we have today. You can get a yield of around 6.2%, which is very close to high yield, and which is not too far to single Bs, which again, as we've seen, exhibit much more default rates as well. So the yield after default is not in favor of single Bs, it is in favor in income strategies. So what do we have in these portfolios? What do we do? Very simply is to look at the entire universe broadly and identify any type of company that pays yield without facing too much default risk. And it's worth taking again the volatility. So you have more spread volatility, you have more yield volatility, but we're willing to take this risk in this very safe environment for default. So low investment grade, high BB rated corporate bonds, subordinated debt, emerging market debt, CLOs as well, single A's and BBB tranches of CLOs are something which is very attractive and interesting for us. The whole point of those strategies, and that's the reason why we've opened up and broadened the investment universe, is that in the end, the name of the game is relative value. Some bonds are cheap, some bonds are expensive, they all have their history. The idea is to have the agility with one single team to look at the entire spectrum of opportunities and to find the bonds which are the most attractive. If we look in particular in our strategy that is above 1 billion that we launched 3 years ago, you see that we have an interest rate duration on the left side of about 6 years of duration, so it's pretty high for those type of strategies. That confirms the view that we think central banks will continue cutting rates. As I said, central banks have a dovish framework. You see that the average rating is BBB, very diversified in terms of holdings, and it spreads, the risks are spread across different opportunities. We have sovereigns, it's mainly Mexico, Brazil, South Africa, and the UK. Both are, the 4 of them are emerging market countries, including the UK. We have investment grade corporate bonds at 12%. Double B corporates is stable companies, stable cash flows. We like them. We view double Bs as the new investment grade in a way. I think you've understood that. And the rest follows through. We like banks, and securitized debt is actually very attractive. It's CLOs. I don't know if you know CLOs, but basically the underlying is loan. And the very interesting feature of CLOs is that you get full transparency on the underlying portfolio. So it's a competition to private markets in a way, but with structures which are well defined, which have been tested in the past, and with underlying securities, which basically where you get full transparency on. So you know exactly what you're having, unlike private markets. I'm not saying private markets are not good, but what I'm saying is this market on the CLO side has the advantage of being fully transparent and clear in terms of the rules. One of the key things we do in this management of this new strategy is to basically look at the correlations between spread and interest rates. And that's one of the key features, I think, going forward, is to be quite active on the management of the duration. I think what is very interesting is that, like 20 years ago, people were managing less actively duration, but were more active on the credit part. I think what should be the anchor in the portfolios should be credit now, as in low default rates again, but probably being a little bit more active on the duration side. Why? It comes back to this nominal growth and inflation. Let me show you this graph again. When you try to keep inflation at 2%, there's always the risk that you're too dovish and that inflation goes back again. Because for central banks, it's better to have higher inflation than lower inflation. If you have inflation which is too high, you can address it. If you have inflation which is too low, it's more difficult to address. So in this 2+2 targeting, you take the risk that sometimes inflation spikes a bit. And that's the reason why, in reality, interest rate is becoming more volatile than spread risk. And that's what we've seen very concretely over the last 3 years, is that you'd rather be active on the duration side, which bears the main risk we think, than being overly active on the credit side. On the credit side, you buy corporates you like, you keep them, you're happy with them. What matters is what monetary policy do, what central banks are doing, and what is the pricing of the market of the terminal rates. Currently, the Fed is priced at 3%. It's okay. We think the Fed will cut down to 2.5%. That's the reason why the duration is very high in the portfolio. The mandate is 0 to 6, but we'd rather be more active on the duration side as a hedge than being active on the corporate side. This is the performance. We like to compare ourselves to ETFs because in reality competition is first and foremost ETFs, and you see that having an income strategy which focuses on triple Bs and double Bs, doing simple things, looking at the bonds, doing relative value, and at times hedging interest rates, provides an excellent performance because we're beating investment grade by a wide margin. That was expected, but we're doing better than a high yield ETF with more volatility and lower expected defaults. And what is very interesting is that we're beating the high yield ETF at a time when the market is rallying. So it's more difficult to beat high yield when the market rallies. It's easier to beat it when the market falls because, of course, double Bs are safer. But the fact that we've been able to outperform the high yield market with a strategy which is on average investment grade is a testimony that this framework of thinking is, I think, the really good one. One last slide. It's quite striking. I don't know if you look at it this way. That's job creation in the US on a yearly basis. 2025, growth is outstanding. We're above potential. And the job creation is zero. Zero. So what do we need to create jobs? That's why central banks will be dovish, and that's why the Fed will cut. And that's why, because they will cut, there is a risk that inflation picks up, and that's the reason why interest rate will continue to be quite volatile, we think. As for credit, it's good news because they will go on with deficits, they will go on with cutting rates because it's the only way to protect the job market. Again, the two risks are AI and China. One is a risk to services labor, and the other one is a risk to manufacturing labor. And everybody knows it. Trump knows it as well. That's why we have this framework again. I'll stop there. I wanted to give you really, in a nutshell, the core views and the core investment conclusions we have. I wanted to be short because the weather is very nice outside. So do you have any questions on that? Do you agree, don't agree? I have a friend in the room, Sandro. So Sandro, do you want to start with a question maybe? Yes.
On loss of creation of jobs.
Yeah.
Forward, especially for the kind of workers we have here.
Yeah.
The credit aspect is also true, in the sense that the leverage is on the government side. It's been for a while now, during the big crisis. And to look at the arbitrage that you can get from CLO, securitized assets, or AT1s, basically beef up your return. It's also very interesting, no? Because we're not tradable, if you see.
Yes.
Securities, as you mentioned, vis-à-vis private debt, which is a big issue for people because of the technology as well, software.
Yeah.
And you have these rules that in private market you have 23% of software exposure, you have only 13 in leverage loan, which is what's going into the CLO.
Yeah.
Only 3% in high yield.
Yeah.
So basically, from a macro perspective, you're also less exposed
To the losers, potentially.
Yeah, it's exactly putting some pressure on the private market mindset right now.
Yeah.
We will see right now. So, yeah, I think it's a very well articulated way to generate income on my side. We can be devil advocates on the fact that you are performing maybe high yield on the way up as well. Is that basically you get this long duration, credit duration on the CLO, for instance, if you have triple B, which is about 2 times the
Yeah.
underlying high yield index.
Yeah.
Not to put it this way, but it's a small portion of it.
Yeah.
So, but I think it's a good one because it's more protective of default rate that you would be in the high market.
Yeah.
Further away from. So, tough to break the. And default rates are implied, as you said, no? So
Yes.
it's not even realized.
No.
It's implied by the spread.
Yeah.
Spreads are tight, so the implied might increase with a wider spread.
Yeah.
Still, it's low probability to default.
Yeah.
In realized terms.
Yeah.
Lower than the implied.
Yeah.
Difficult to challenge it.
He's a friend, I said, all right, so he's not objective. Yes.
My question is, the spreads are very tight.
Yeah.
Especially in investment grade.
Yeah.
Would you consider that actually spreads have to be negative to some range?
There's a risk. It's a very good question. There's a risk. Certainly against swaps and potentially against treasuries. If you think about the countries around us, certainly, except Switzerland, where spreads will stay positive, hopefully. But yeah, there is a risk, absolutely. That's why I don't really see spreads as that expensive. I really view them as fair value, given the new environment we're in. High yield today is not what it was 20 years ago. The average quality is better. The leverage is lower. Banks certainly help by being much less risky than they were 20 years ago. So yeah, it's a possibility. Yeah.
There has been some instance now of credit
Yes.
pricing already through treasuries.
Yeah. But there is a limit to it. But there's a limit to it, which is the derivatives market. every time there's a crisis, the market which is the most liquid is derivatives, in particular futures. And we've seen it during 2008, 2007, that futures on the treasuries are much more liquid than the treasuries themselves. So Germany and the US still have, and the UK, every bond which is the underlying of a future derivatives contract should, for at least the time being, be a safe haven at times of crisis. So it can be negative, but not always. I wouldn't bet on that. But what is certainly true is that I think people should move out of governments into corporates. Many have done it already, but flows will go there, I think.
Just a short question. What is the average option-adjusted spread of the portfolio currently? Any kind of spread.
I would say it's about 280, 250. Is it possible? I haven't looked at it recently. The thing is, the treasury market pays you about, let's say, 375. So it's 250 about. Yeah, on average. But it's a combination of CLOs. You know, CLOs are 300 plus. There is emerging market debt, there are 81, so there's a lot of different things. So I would say 250 is the yield pickup that you get versus treasuries.
And what's the underlying carry, like the current yield?
It's 6.3.
Okay, that's not the like yield to worse, let's call it. It's like the underlying from carry.
Yeah.
The coupons.
No, the coupon. Well, currently the yield to worst is 6.3.
And the coupon yield.
The coupon yield, unadjusted for the price of bonds. I wouldn't say.
Like average.
Probably about the same. Yeah, probably about 6% as well, I would think. Most bonds are traded at around par. Many securities have been bought on the primary market, so I would say about that.
This is all cash, there is no
All cash.
no
No derivatives.
derivatives.
No. No leverage, no economic leverage on credit. It's really back to basics. Yeah.
From my side, please.
The top holdings. It's very diversified. I don't have the top holdings here in the presentation. Maybe further down the line, let's see. In the appendix, we will see. There must be banks, I think, top holdings. Oh no, we don't have them. Top holdings. The maximum weight in the portfolio is about 1%, so I would say it's 81s, the top holdings. Oh no, and I'm sorry, the top holdings would be emerging market sovereigns, because we have 5% Mexico, 5% Brazil, 5% South Africa. So that would be the top weights, banks and emerging market sovereign bonds.
And then do you have any other currency classes?
Everything you want. Swiss franc, euros, Singapore, Israeli shekel, so the main fund is in dollars. It's true, right? Dominique, we have so many different currencies.
We have like accumulated share classes as well as distributed share class, because we know that the Asian clients prefer to have distributed share classes, so we offer the full range of the spectrum.
Yeah, so the main share is in dollars, and then we have those hedger classes for every type of currency. Yes, sorry.
Thank you. To mention, you have a very calming voice to mention.
Okay.
I wanted to ask, you mentioned in the first or second slide, there is AI investment, I think, and China.
Yes.
And actually not investment, productivity. I read every second, third day concerns regarding AI, companies investing in AI, and the concern on the impact on the bond markets. But all the companies which are investing in AI, Microsoft, Amazon, Google, Meta, they have very low leverage, they have very high credit ratings, they have plenty of cash. Why is it such an issue for these companies in the eyes of the market to invest billions in AI?
I think the issue is twofold. The issue is that numbers are very big, so it's scaring people. It's just because cash flows are so big, but now that we realize that we invest those cash flows into real economy through data centers building, the numbers are very big. It's unusual. It's never happened before. So I think one, the numbers are very big, and the second is the equity valuations are fairly high. So there's very limited room for disappointment. Even you've seen with NVIDIA yesterday, very good results, and the market is not going up. By the way, we run a convertible bond strategy as well. We have outstanding performance, and we have this performance by investing in the winners of AI and avoiding the losers. It seems obvious, right? But it's working. At least it's working. So I really follow closely the AI thing. But the conclusion, I totally agree with you. When I've tried to look at the different recessions that happened in the past, I think to me the closest one was 1910. It was railways. And apparently at some point there were problems and there was a recession. It was just before World War I. You find two elements in this recession, which are, I think, key for analyzing what is happening today. One is that there was over leverage. That's not the case today. If you look at Google, they finance a little bit with that, but just a tiny bit. So there's not over leverage. And the second is overcapacity. Because when you have overcapacity, of course, at some point your cash flows drop in your investments, not the cash flows from cloud. If you take Google, they invest the cash flows from cloud to invest in AI data centers, so it's different. But if you invest in something and suddenly there's overcapacity, then the cash flows you get from those investments drop at a time where you have over leverage. And we're absolutely not in this situation. I would totally agree with you. So again, I think there is a risk in terms of equity valuation, and it's just an overall uncertainty about the job market. Everybody is scared, I think, about what's going to be the future, in particular for the kids. Every parent which has a kid in 18, 20, 22 looks for a traineeship. It's getting harder. So I think they are scared. Human beings are like that. But from a financial perspective, I think it would be more, at least for now, a transfer of wealth from the losers to the winners than a global macro risk. So I would tend to agree with your interpretation. It's going to take years to build over leverage and over capacity, years. And there are many constraints, physical constraints that we're not used to, energy constraints, infrastructure constraints, rare earth, there's so many things that we can list. So it will take time to build over capacity. It's very true. Yeah, it's an additional point, absolutely.
The danger is more Oracle with very leverage, not the big ones, and then everything on the private side, no? The core wave, where you go for really, really different.
We don't pay. We don't pay him. He's independent opinion. No? Dominique, conclusion?
The conclusion is, if you're interested to learn more about the strategy, visit us at the booth. We are here on the first floor, so we can share more information, share the presentation with you guys, and also get in contact with you if you refer to visit you on the ground. So thank you very much for attending. Much appreciated, and thank you, Philippe, for the nice presentation.
Thank you very much.